say on the spending side on programs.
That's a great asset. More inflation. Some folks have raised worries that this could be a sign of persistent inflation, but that's not our view.
Our expectation is that these high inflation readings that we're seeing now will start to abate.
Finally, we can breathe a sigh of relief. All right, catch your breath, because we finally got a reprieve from the Fed on their most aggressive interest rate hikes since the early 80s. And just to show why this is wonderful news, stocks went ahead and jumped on the afternoon of Wednesday, November 30th, after the Fed chair, Jerome Powell, indicated that the Fed might ease off of these big interest rate hikes starting in December, which is this month. Specifically, the Dow Jones rose about 737 points, or 2.2%. The S&P was up 500, which is 3.1%, and the NASDAQ 4.4%. That's all the tech stocks. Huge day. The markets are loving this. So what's it all about? And most importantly, what does it mean for us? So in this video, let's take a closer look at some of the highlights from Mr. Powell's speech, what it means for the market, and most importantly, what it means for you and me. All right, you got to do me a favor real quick and subscribe if you haven't already, and like this video. Let's get started. So in an hour-long session at the Brookings Institute, Federal Reserve Chair Jerome Powell indicated that the next rate hike expected on December 14th will only probably be 25 to 50 basis points, which this is a welcome relief, because since the last four of them have been risen by 75 basis points, that means we've already gotten our Fed funds rate from 0 to 3.75 to 4 before the end in only 1 year. That's the highest level, by the way, since 2007. And this is the biggest increase this quickly since the 1980s, when Paul Volcker was a Fed chairman. So what does this mean for us on the street? Let's start at the very top. High interest rates, which are influenced by central banks, slow the economy down by making it more costly for consumers and businesses to borrow. Specifically for consumers, where you and I fall. High interest rates means more expensive loans, mortgages, and credit card debt. The result? Well, spending is discouraged, leading to a beatdown of the overall economy. However, a smaller interest hike like what Mr. Powell is promising is good news for you and me, because it means that the cost of borrowing will not be going up as quickly as it has been all year long. Essentially, you can expect loans, mortgages, credit cards to at least maintain their current levels, or maybe get a little bit better, a fraction better in pricing.
Well, it makes sense to moderate the pace of our rate increases,
Powell said, before adding that the rate hikes may come
as soon as the December meeting.
Now, just in case you're wondering what he meant by meeting, he meant Federal Open Market Committee meeting that happens on December 14th, when they're expected to announce the next federal funds rate hike. Now, you might wonder, how does the Fed's decision affect the interest rates? See, I should have said this earlier, but I'll just mention it to you guys now. It should be fine. All right, the Federal Reserve's rates are a benchmark that banks and other financial institutions use to come up with an interest rate that they offer overnight to each other when they need to loan each other money. What does that do for the market? Well, that affects all interest rates. Okay, now with that out of the way, let's take a closer look at what happened after Powell's announcement. Now, there's no denying that Wall Street hailed Mr. Powell's latest remark. The Dow Jones Industrial Average closed up 737 points, or 2.2%, ending a 3-season losing streak. Tech stocks fared even better, with NASDAQ roaring over 4.4%. And experts noted that the market surge followed the announcement was a welcome relief. After all, many investors were wary of Mr. Powell, and he's going to be more hawkish as he has been over the last few meetings. But I think we feel like the dark cloud is gone. Up next, let's talk about other key highlights of Mr. Powell's announcement. Inflation is easing, but don't celebrate just yet. See, Jay Powell also revealed that the inflation was easing before quickly throwing in a warning. What he did was he reaffirmed the Fed's commitment to a sufficient restrictive monetary policy that'll bring inflation rate down from year-to-year rate of 7.7 to 2%. His idea is to ensure that the monetary policy stays restrictive until real signs of progress emerge on inflation. He did say, despite some promising developments, we have a long way to go in restoring stability. And he also reiterated that the policy moves such as interest rate increases and reducing the Fed's bond holdings generally take time to make their way through the system. Some people say up to a year. It's for this reason more sensible and moderate rate increases as we approach a level of resistance that is sufficient to bring inflation down. Now, according to him, it'll take a substantially more evidence to give comfort that inflation has been declining. By any standard, inflation remains much too high. Okay, so what stood out to me is that he basically said, look, inflation is really messing things up. It's a very, very big hardship on Americans out there. It strains budgets, it shrinks paychecks, but they also don't want to go into this wage price spiral. Well, he was decent enough to narrow it down, noting that this is especially painful for those that are least able to meet the higher cost of essentials like food, housing, and transportation. Most of all, he notes that while good inflation has been easing, the cost of housing is likely to continue rising over the next year, while crucial price measures for services remain high and the labor market is tight. So brace yourself, the labor market is in turmoil. During the announcement, Powell acknowledged that the labor market was still tight, seeing the job openings had outnumbered available workers by 2 to 1, and while the gap has since closed to 1.7 to 1, it remains well above historical norms. So this situation in the labor market has actually led to a huge boost in the worker wages that nonetheless have failed to keep up with inflation. To be clear, strong wage growth is a good thing, but for wage growth to be sustainable, it needs to be consistent at 2% with inflation, Powell said. He went much into detail on the factors keeping the labor force participation on the lower end, such as aging population, the COVID era, retirements, and weak immigration. These things, according to him, continue to seriously contribute to the imbalance between openings and available workers, and he doesn't think it'll reverse soon. Now, some people say there is no recession on the horizon. In fact, the Bureau of Economics Analysis revised its forecast for the U.S. gross domestic product for the third quarter upwards of 2.9%. Now look, this is great news. It implies that the economy is not even near a recession. Now look, at first this is probably like counterintuitive as far as signs of the resilient economy, like consumer spending and strong labor market. They're bad news for further rate hikes as the Fed chair seeks to use his main tool to drag the economy down and rein in the inflation. So, what can we expect from now and on? While we can look forward to a slowdown in the pace of rate increases, it helps to remain open and ready for whatever. I mean, after all, the Fed chair knows that how much further we will need to raise rates to control inflation and the length of time it would be necessary to hold policy at these restrictive levels had yet to be determined. Besides, he gave no indication on his forecasted terminal rate, defined as the peak spot where the benchmark interest rate, the Fed funds rate, will come to rest before the central bank begins trimming it back, otherwise known as the Fed pivot. Okay, so what he did was provided a subtle clue, saying that it'd probably likely be higher than 4.6. That's what was indicated by the policymakers in their September Summary of Economic Projections, or their SEP. Okay, so he reaffirmed that beating inflation would require holding the policy level to restrictive for some time, which led investors to believe that we could see rate cuts coming as soon as next year when the economy slows. Now, I want you guys to mark two different dates on the calendar, December 13th and December 14th. Okay, so why are we looking out for these days? Well, the central bank meets on these days, and the policymakers are expected to approve a 0.5 point rate increase, as well as give new projections for rates, economic growth, inflation, employment, all in the coming up years. And even so, with the coming 0.5% rate increase, the central bank has lifted the overnight policy rate from near zero as of March to the 4.25 to 4.5 range, the swiftest change in rates since former Fed Chair Paul Volcker was battling even worse rising prices, at least according to the data. There are a lot of people that argue that because the data has changed so much over the years, we're not comparing apples to apples, and I think I agree with that. Okay, so the last inflation report that we got was over 6%, which is still about 3 times more than the target inflation rate of 2%. All right, now what do you think about the latest developments regarding the Fed funds rate? Do you think that they're doing enough to curtail? Now, what do you think about the latest developments regarding the Fed funds rate? Do you think enough is being done to make this inflation go away, or do you think they need to go a little harder? Let me know in the comments below. And if you enjoyed this video, smash that thumbs up button and share the video with everybody that you know. And remember to subscribe and turn on the little notification bell so that way you'll know whenever I put out other videos like this. All right, guys, bye for now. See you in the next one.